And then, of course, for both the Fed and investors to digest what this all means when it comes to the potential rate cuts, Yahoo Finance's Alexandra Canal joins us to discuss the chatter on Wall Street that we've got coming out. Allie.
Now, Brad, the narrative has certainly shifted when it comes to just how much the Fed will cut rates in September, but markets and economists do expect some form of a cut by the end of that meeting. So let's take a step back and talk about what all of this means for you. As we know, interest rates have remained elevated as the Fed works to bring inflation back down to its 2% annual target. The thesis there being that if rates are high, consumers won't spend or borrow as much money. But here's the problem. There have been some areas of the economy that have just remained super sticky despite these high rates. In other words, prices just haven't come down. We were just talking about shelter prices up 5.1% year over year. Food, motor vehicle insurance, medical care, personal care, all seeing significant yearly gains. So while this report did come in line with expectations, some economists say we're still not seeing enough of a deceleration to support a 50 basis point cut. And that's being reflected in markets, with traders now pricing in a roughly 40% chance the Fed cuts rates by 50 basis points in September. That's down from 70% odds just 1 week ago. Instead, the majority believe a 25 basis point cut is on the horizon, which again is higher from last week. But remember, there's still the argument there that the recent weakness we've seen in the labor market, that could actually force the Fed to be more aggressive with those cuts. We also have retail sales data out Thursday, which will be another data point the Fed will be closely watching. All this to say, we should expect some form of relief soon, as lower interest rates means borrowing costs will be cheaper, and that's something that many Americans are certainly looking forward to. Brad?
All right, Allie, thanks so much. Appreciate it.